Did you know that 67% of millennials have absolutely nothing saved for retirement? That's right, 2/3 of an entire generation are walking a financial tightrope without a safety net. But here's the real shocker. Most of them aren't broke, they're just making the wrong moves with their money. Are you one of them? If you don't start investing now, you could be leaving millions on the table by the time you retire. Scary, right? But don't panic. In this video, I'm going to reveal 7 essential tips for beginners to start building wealth. And trust me, these aren't your grandpa's boring investment strategies. By the end of this video, you'll have the tools to start growing your money like a pro. Stick around, because the last tip could literally change your financial future overnight. Welcome to Investing for Beginners. 7 essential tips to start building wealth. I'm not just going to show you how to invest, I'm going to show you how to start seeing results within 1 week. Yes, you heard that right, 1 week. So grab a pen, because you're about to learn how to turn your spare change into serious cash. But before we dive in, hit that subscribe button. Next week, we're diving deep into more ways to increase your wealth. You don't want to miss it. Now, let's get started on your journey to financial freedom. Pay close attention, because these tips could be the difference between retiring on a yacht or retiring on your kid's couch. Start yesterday. Okay, I know what you're thinking, but I can't time travel. Well, neither can I, yet, but here's the next best thing. Start today. The magic of compound interest means that the earlier you start, the more your money grows. It's like a snowball rolling down a hill, gaining momentum and growing larger as it picks up more snow. Let's break it down with some eye-opening numbers. If you start investing $200 a month at age 25, by the time you're 65, you could have over $520,000 assuming a 7% annual return. Now here's the kicker. If you wait until you're 35 to start, that amount shrinks to about $245,000. That's more than $260,000 lost just by waiting 10 years. But wait, it gets even more mind-blowing. Imagine starting even earlier, at 18 instead of 25. That same $200 a month could grow to over $1 million by age 65. That's the extraordinary power of compound interest at work, folks. It's like a financial superpower, and time is your loyal sidekick. Now I know what some of you are probably thinking, but I'm already past 25 or 35 or 45. Here's the good news, it's never too late to start. The best time to plant a tree was 20 years ago. The second best time is today. Whether you're 20 or 50, starting now can still make a massive difference in your financial future. Here's exactly how to take action right now. 1. Open an investment account. Platforms like Vanguard, Fidelity, and Charles Schwab make it simple. You can set one up online in minutes. It's easier than ordering pizza, and infinitely better for your financial health. 2. Set up automatic transfers. Even if it's just $50 a month to begin with, consistency is key. Set it and forget it, and watch your wealth build up like clockwork. 3. Choose a simple investment to start with. An index fund that tracks the S&P 500 is an excellent starting point. Imagine owning a tiny piece of 500 of America's largest companies with just one investment. Here's a real-life example to put it into perspective. Meet Tom. Tom began investing $100 a month in an S&P 500 index fund when he was 22. By 32, his investments had grown to over $16,000. That's $4,000 more than what he actually contributed. If Tom keeps this up until 65, his investment could exceed $300,000. That's an impressive return for just $100 a month, right? Pro tip, increase your contributions whenever you get a raise. For instance, if you get a 3% raise, allocate 1% of that raise toward your investments. This strategy boosts your wealth building while still giving you more take-home pay. Time in the market beats timing the market. Unless you have a DeLorean and a flux capacitor, in which case, can I borrow it? But seriously, if you haven't started investing yet, don't beat yourself up. It's never too late to begin. The important thing is taking the first step today. Now let's move on to the next tip, where you'll learn how to build a financial fortress that can weather any storm. Imagine putting all your eggs in one basket, then dropping that basket. Ouch, right? That's essentially what happens when you fail to diversify your investments. Diversification is your financial safety net, a fancy way of saying, don't put all your money in one place. Here's how to create a well-diversified portfolio like a seasoned pro. 1. Stocks. These are like owning a small slice of a company. When the company does well, you share in the profits. But remember, individual stocks come with risks, much like betting on a single horse in a race. 2. Bonds. Think of these as IOUs from corporations or governments. Bonds offer stability and lower returns compared to stocks, making them the slow and steady tortoise in your financial race. 3. Real estate. You don't need to buy property outright to invest in real estate. Real estate investment trusts, REITs, allow you to invest in property without dealing with tenants, maintenance, or late-night plumbing emergencies. 4. Index funds. These are like purchasing a slice of the entire stock market. With one investment, you gain exposure to hundreds or even thousands of companies. Think of it as betting on the entire race rather than a single horse. 5. International investments. Diversify across borders by adding international stocks and bonds to your portfolio. This global approach spreads your risk and ensures your financial eggs aren't all in one country's basket. 6. Commodities. Investing in gold, silver, or oil can act as a hedge against inflation. But be cautious. Commodities can be as volatile as a roller coaster ride. 7. Cash and high-yield savings accounts. Keeping some cash handy ensures you're prepared for emergencies. It's like having a fire extinguisher. You hope you'll never need it, but you're glad it's there. Now, you might be wondering, how much should I allocate to each category? Great question. This is where the rule of 110 comes in handy. Subtract your age from 110. That's the percentage of your portfolio that should be in stocks. The remaining portion can be allocated to safer investments like bonds. For example, if you're 30 years old, 80% of your portfolio could be in stocks, with 20% in bonds. As you age, you can gradually increase your bond allocation for more stability. Here's an example of a well-diversified portfolio: 60% in a total stock market index fund, 15% in an international stock fund, 20% in a bond fund, 5% in a REIT. This blend offers exposure to thousands of companies across various sectors and countries, along with the stability of bonds and the growth potential of real estate. Pro tip: diversification is your best defense against the unpredictable swings of the market. It's like having a financial fortress. If one part takes a hit, the others can help balance the impact. Diversification is like a financial buffet. You don't just load up on desserts, tempting as they may be. You need some vegetables too. Think of bonds as the broccoli of your portfolio. Feeling overwhelmed? Don't worry, you don't need to do everything at once. Start small, which brings us to tip number 3. Here's a mind-blowing fact. You can start investing with as little as $5. Yes, $5. That's less than the cost of a fancy coffee or a fast food meal. The world of investing is no longer reserved for the wealthy or the Wall Street pros. Apps like Acorns or Robinhood let you invest your spare change, making it easier than ever to dip your toes into the market. It's like finding money in your couch cushions, except instead of lint and stale popcorn, you're uncovering the potential to grow real wealth. Why starting small matters? Starting small eliminates the intimidation factor of investing. Most people believe you need thousands of dollars to get started, but the truth is, even the smallest investments can snowball into something significant over time. Thanks to compound interest, every dollar you invest today has the potential to grow exponentially in the future. By starting now, no matter how small, you're creating the foundation for bigger opportunities later. Practical ways to start small. Here's how to make small investments work for you. 1. Roundup apps. These apps round up your everyday purchases to the nearest dollar and invest the spare change for you. For example, if you buy a sandwich for $6.50, the app will round it up to $7 and invest the remaining 50 cents. It's like tricking yourself into saving and investing without even noticing. Apps like Acorns have made this process effortless and fun. 2. Micro-investing platforms. Start with just a few dollars and build from there. Apps like Stash or Robinhood allow you to buy fractional shares of stocks or ETFs. Even if you can't afford an entire share of a pricey stock like Amazon or Tesla, you can still own a piece of it. Think of it like buying a slice of pizza instead of the whole pie. It's a smaller commitment, but just as satisfying. 3. Fractional shares. Many brokers now offer fractional shares, letting you buy a portion of expensive stocks for as little as $1. This means you don't need to wait until you have hundreds or thousands of dollars to invest in big-name companies. You can start small and gradually increase your stake over time. 4. Dollar cost averaging. Instead of trying to time the market, a strategy even seasoned pros struggle with, dollar cost averaging allows you to invest a fixed amount regularly. This strategy smooths out the ups and downs of the market and ensures you're consistently putting your money to work. 5. Reinvest dividends. When you receive dividends from your investments, reinvest them instead of pocketing the cash. It's like planting seeds from the fruit you've already grown, giving you the chance to grow even more. Let's look at a real-world example to see how starting small can make a big difference. Meet Sarah, a 22-year-old barista who wanted to start investing but didn't have a lot of money. She began using a Roundup app last year, linking it to her debit card. Every time she made a purchase, the app rounded up the total and invested the spare change. Over the course of the year, Sarah invested $300 without even realizing it. Now, $300 might not sound like much, but let's talk about the magic of compound interest. If Sarah leaves that $300 in an investment account earning an average return of 7% per year, it could grow to over $3,000 in 40 years. And that's without her lifting a finger. But Sarah didn't stop there. She also set up a monthly investment of $50 into a low-cost index fund. Between her roundups and her monthly contributions, Sarah is on track to accumulate over $100,000 by the time she's 40, assuming the same 7% annual return. Not bad for someone who started with just a few spare coins, right? Starting small doesn't mean you have to stay small. Here are some additional strategies to help you grow your investments. Increase contributions incrementally. Set a goal to increase your investment amount by 1% every month. For instance, if you're investing $100 this month, aim for $101 next month, $102 the month after, and so on. These small, gradual increases won't feel like a burden, but they'll add up quickly. Use windfalls wisely. Got a tax refund, birthday money, or a bonus at work? Instead of spending it all, invest a portion of it. These lump sums can give your portfolio a significant boost. Set and forget. Automation is your best friend when starting small. Set up automatic transfers to your investment account so you never miss a contribution. Think of it as putting your wealth building on autopilot. Why starting small is like learning to swim. You don't jump straight into the deep end, right? You start in the kiddie pool. Just don't forget your floaties. Investing, like swimming, takes practice and confidence. Starting small lets you build that confidence without risking too much. Over time, you'll move from the kiddie pool to the deep end, ready to make bigger investments and take calculated risks. The big picture. Remember, starting small doesn't mean thinking small. Every investor from Warren Buffett to the everyday millionaire next door started somewhere. The key is to begin, no matter how tiny your first step might feel. Over time, those small efforts will compound into something much larger. Take the first step today. If you're ready to start your investing journey, don't let the fear of starting small hold you back. Whether it's a roundup app, fractional shares, or a monthly contribution to an index fund, the important thing is to take action. The best investment you can make is the one you start today. Investing without a clear goal is like embarking on a road trip without a destination. You might have fun along the way, but you'll probably burn a lot of gas and end up lost. Setting clear, achievable goals is a cornerstone of successful investing. It gives you a roadmap, keeps you focused, and helps you measure progress along the way. So, how do you set goals that will set you up for financial success? Follow these 5 simple steps. 1. Be specific. Generic goals like I want to save for retirement won't cut it. Instead, be as detailed as possible. For instance, I want to save $500,000 for retirement by age 65 is much better. Specific goals make it easier to create actionable plans and track your progress. Ask yourself questions like, how much money do I need? What's my timeline? What will I use the money for? When you know the exact destination, it's easier to chart a course. 2. Make it measurable. Breaking your big goal into smaller, measurable milestones is a game changer. Let's say your goal is to save $500,000 in 30 years. That might feel overwhelming, but when you break it down, it's about $16,700 per year, or around $1,400 per month. Doesn't that feel more achievable? Measuring progress keeps you motivated. Every dollar you save gets you closer to the finish line, and watching your investments grow is incredibly rewarding. 3. Keep it realistic. We'd all love to be millionaires overnight, but unless you win the lottery or strike gold, that's not going to happen. Unrealistic goals can lead to disappointment and frustration, which might make you give up altogether. Instead, stretch yourself, but stay grounded in reality. Hard work and consistency over time will always beat get-rich-quick schemes. Here's an example of an unrealistic goal. I want to make $1 million in 1 year starting from zero. A more realistic alternative might be, I want to save $100,000 in the next 5 years through investing and side hustles. 4. Set a timeline. Deadlines aren't just for work projects, they're crucial for your financial goals too. Divide your goals into short-term, 1 to 5 years, mid-term, 5 to 10 years, and long-term, 10+ years. Each category will require different strategies. Short-term goals, save $5,000 for an emergency fund within the next 12 months. Mid-term goals, save $50,000 for a house down payment within 5 years. Long-term goals, build a $1 million nest egg for retirement by age 65. Timelines create urgency and help you prioritize. Without them, it's easy to procrastinate. 5. Make it relevant. Your goals should align with your values and life plans. For example, if you value travel, one of your goals could be saving $10,000 annually for international trips. If family is your priority, you might focus on building a college fund for your kids. Investing isn't one size fits all. Tailor your goals to fit your unique aspirations. Real-world example. Let's meet Mike, a 28-year-old software developer. Mike set a bold but realistic goal to save $100,000 by his 35th birthday. He started by breaking it down into monthly targets, deciding he needed to save $1,200 a month. To stay on track, Mike set up automatic transfers to his investment account. Used a spreadsheet to monitor his progress. Adjusted his strategy whenever life threw him a curveball. 2 years in, Mike is already 40% of the way toward his goal. Seeing that progress motivates him to keep going, even when it means skipping that extra coffee or cutting back on impulse purchases. Pro tip: write down your goals and put them somewhere visible, on your fridge, bathroom mirror, or even as your phone wallpaper. Constant reminders will help you stay focused and motivated. Why writing goals down matters. Studies show that people who write down their goals are 42% more likely to achieve them. Why? Because writing makes your intentions tangible. It transforms a vague idea into a commitment. Think of your written goals as a contract with yourself, one you'll be more likely to honor. Setting investment goals is like planning a diet. If your goal is to lose 50 pounds by tomorrow, you're setting yourself up for failure, and probably a stomachache. Overcoming common goal-setting challenges. Now let's address the elephant in the room. What if your goals feel out of reach? Or what if you're not sure where to start? Don't worry. Here's how to tackle common goal-setting hurdles. Feeling overwhelmed? Start small. If saving $500,000 feels impossible, start with $5,000. Focus on achieving one milestone at a time. Small wins build momentum and confidence. Unsure about your timeline? Be flexible. Life happens. Maybe you lose your job or have unexpected expenses. It's okay to adjust your timeline. Flexibility doesn't mean failure, it's a natural part of the process. Afraid of mistakes? Embrace them. Mistakes are inevitable, especially when you're new to investing. Don't let fear hold you back. Every misstep is a learning opportunity. The game changer. Align goals with your why. Your why is the driving force behind your goals. It's what keeps you motivated during tough times. Ask yourself, why do I want to build wealth? What will financial freedom allow me to do? Who will benefit from my success? Maybe you want to retire early and travel the world, or maybe you want to give your kids a better future. Whatever your why, keep it front and center. Real-life motivation. Let's revisit Mike. What keeps him motivated to save $100,000? For him, it's the dream of owning a lakefront cabin where he can spend summers with his family. Every time he feels tempted to overspend, he reminds himself of that dream. Pro tip, visualize your goals. Create a vision board with pictures of what financial success looks like to you. A dream home, a family vacation, or even just a stress-free retirement. Seeing your goals in front of you every day makes them feel real and achievable. Final thoughts on goal setting. Setting clear investment goals is about more than just numbers. It's about creating a roadmap for your future. Goals turn dreams into actionable plans and help you stay focused when the going gets tough. Now that you're equipped to set smart, achievable goals, let's move on to the next tip, where we'll dive into how to pick the right investments for your unique situation. In the age of information overload, it's easy to fall into the trap of analysis paralysis. You don't need a PhD in finance to start investing, but you do need to do your homework. Here's how to research effectively without losing your mind. 1. Start with the basics. Learn key terms like PE ratio, dividend yield, and market cap. Don't worry, I'll break these down. PE ratio, price to earnings ratio. This is the price tag of a stock. A lower PE might mean a stock is undervalued, while a higher PE might mean it's overvalued, but remember, context matters. Dividend yield. This is like the interest rate on a savings account but for stocks. It tells you how much a company pays out in dividends relative to its stock price. Market cap. This is the total value of a company's outstanding shares. It's the size of the company in the stock market world. 2. Use reliable sources. Stick to reputable financial websites and avoid get-rich-quick schemes. Sites like Investopedia, Morningstar, and the financial sections of major news outlets are good places to start. 3. Follow the news. Stay updated on market trends and economic events, but don't let every headline sway your investment decisions. The stock market is like a person with mood swings. It overreacts in the short term but tends to be rational in the long term. 4. Learn from the pros. Read books and listen to podcasts by successful investors. Warren Buffett's annual letters to Berkshire Hathaway shareholders are a goldmine of investing wisdom, and they're free. 5. Use stock screeners. These tools let you filter stocks based on criteria you set. It's like online dating, but for stocks, you set your preferences, and it shows you matches. 6. Understand financial statements. Don't worry, you don't need to become an accountant, but knowing the basics of income statements, balance sheets, and cash flow statements will help you make informed decisions. 7. Paper trade. Many brokers offer paper trading accounts where you can practice investing with fake money. It's like a flight simulator for investors. Remember, the goal of research isn't to predict the future. If you can, please let me know the winning lottery numbers. The goal is to make informed decisions and understand the risks you're taking. Let's look at a real-world example. Lisa, a 30-year-old nurse, wanted to invest in individual stocks. She started by reading financial news for 15 minutes each day and watching educational videos on investing. Then she used a stock screener to find companies with strong financials in industries she understood. Before investing real money, she paper traded for 3 months to practice her strategy. This preparation gave her the confidence to start investing real money, and she's now building a diversified portfolio of stocks alongside her index fund investments. Pro tip: set a limit on how much time you spend researching. Spend no more than an hour a day learning about investing. After that time, take action. Perfect information doesn't exist in investing, so don't wait for it. Researching stocks is like online dating. You want to know enough to make an informed decision, but if you dig too deep, you might never take the plunge, and nobody wants to be forever alone with their money under the mattress. But here's the kicker. Even with all the research in the world, you're going to make mistakes, and that's okay. Which brings us to the next essential tip. Here's a little secret that even the so-called gurus don't like to admit. Everyone makes mistakes in investing. Yes, even Warren Buffett, the Oracle of Omaha himself, has made some epic blunders. The difference between successful investors and those who give up? Successful investors treat their mistakes as stepping stones to greater wisdom. Mistakes aren't failures. They're tuition payments in the school of financial wisdom. Here's how to turn your investing oops moments into opportunities for growth. 1. Keep a trading journal. Write down why you made each investment decision. What was your thought process? What information did you use? Reflecting on your decisions will help you identify patterns in your behavior, both good and bad. Over time, this self-awareness can help you avoid repeated mistakes and refine your strategy. Think of it as keeping a diary for your financial journey. It's not just about documenting what you did, it's about understanding why you did it. A trading journal is like a map that shows where you've been so you can chart a better course for where you're going. 2. Review regularly. Schedule time to review your past choices. Did you panic sell during a market dip? Did you ignore red flags because you got too excited about a hot tip? Be honest with yourself. Reviewing your investments isn't about beating yourself up, it's about learning from your experiences. Identify what went right and what went wrong so you can make better decisions moving forward. 3. Don't be emotional. The stock market doesn't care about your feelings, it doesn't know who you are, and it's not out to get you. Treat your losses as learning experiences, not personal failures. Emotional investing, letting fear or greed dictate your actions, is one of the quickest ways to derail your progress. For example, let's say a stock you bought drops significantly in value. Your first instinct might be to sell out of fear of losing more. But before you do, ask yourself, was your original investment thesis sound? If the company's fundamentals are still strong, the drop might just be a temporary setback. The market doesn't care if you're having a bad day, so don't take it personally. It's like a grumpy cat, it does what it wants. 1. Have an exit strategy. Know when to cut your losses and move on. This doesn't mean panic selling at the first sign of trouble. It means having a clear plan for when an investment isn't working out. Before you buy, decide on your exit points, both for gains and losses. For example, you might decide to sell if a stock loses 20% of its value or gains 50% over a set period. Write your exit strategy down as part of your trading journal. This way you can refer back to it when emotions are running high. 1. Learn from others' mistakes. You don't have to make every mistake yourself to learn from it. Study famous investing blunders to understand what went wrong and how those investors recovered. For example, in 1998, Long-Term Capital Management, a hedge fund run by Nobel Prize-winning economists, lost $4.6 billion in less than 4 months. Why? They believed their models had eliminated all risk. Spoiler alert, they hadn't. By studying others' mistakes, you can avoid making similar errors. It's like learning to ride a bike by watching someone else fall off first. You get the lesson without the scraped knees. 6. Reframe your thinking. Instead of seeing a loss as a failure, think of it as the cost of an education. Just like tuition for a class, every investing mistake teaches you something valuable. What did you learn from this experience? How can you apply that knowledge in the future? When you shift your mindset, losses become less intimidating and more constructive. 7. Stay humble. Success in investing can feel amazing, but don't let it go to your head. The market has a way of humbling even the most experienced investors. Just because you've had a string of wins doesn't mean you're invincible. Stay grounded, stick to your strategy, and never stop learning. Think of the market like a parent. It's great at reminding you that you're not as smart as you think you are. Let's revisit Long-Term Capital Management. Their mistake was overconfidence in their risk models. They believed they had accounted for every possible outcome, but unforeseen market conditions proved them wrong. This failure taught the financial world an important lesson. No model is perfect, and diversification is critical. The fund's collapse became a case study in humility and risk management. Keep a trading journal to reflect on your decisions and analyze patterns in your successes and failures. By learning from your mistakes and the mistakes of others, you'll develop the resilience and insight needed to succeed. Embracing mistakes is like getting a bad haircut. It might seem catastrophic at first, but give it time, it'll grow back. And hey, there's always hats. The truth is, mistakes are inevitable. But how you respond to them is what separates amateurs from professionals. Successful investors don't dwell on their losses, they learn from them and move forward. Each mistake is an opportunity to sharpen your strategy and build confidence. Now pay attention, because the next tip is the secret sauce that separates the casual investors from the wealth builders. Imagine if you could build wealth in your sleep. Well, with automation, you practically can. Automating your investments takes emotion and forgetfulness out of the equation. Here's how to put your wealth building on autopilot. 1. Set up automatic transfers. Have a portion of your paycheck go directly into your investment account. 2. Use robo-advisors. These AI-powered platforms automatically invest and rebalance your portfolio. 3. Dividend reinvestment. Automatically reinvest dividends to buy more shares. 4. Regular rebalancing. Set reminders to rebalance your portfolio every quarter. Start by automating just 1% of your income and increase it by 1% every few months. You'll hardly notice the difference in your paycheck, but your future self will thank you. Automating your investments is like having a robot butler for your money. It does all the work while you sip pina coladas on the beach, or let's be real, while you binge watch Netflix. Now, as promised, here's the mind-blowing tip. The most powerful investment you can make is in yourself. Here's a truth bomb. You are your own best investment. Increasing your knowledge and skills can lead to higher income, which means more money to invest. Here's how to invest in yourself. 1. Continuous learning. Take courses, attend workshops, and read books on finance and investing. 2. Develop new skills. Learn coding, digital marketing, or any in-demand skill. 3. Network. Build relationships with successful people in your field. 4. Health. Invest in your physical and mental health. A healthy you is a wealthy you. Allocate a percentage of your income specifically for self-improvement. Think of it as your personal growth fund. Investing in yourself is like upgrading your smartphone. Sure, the old model still makes calls, but the new one can do so much more, and it doesn't crack as easily when you drop it on your face while scrolling in bed. There you have it, folks. 7 essential tips plus a bonus to begin building wealth as a beginner investor. Remember, investing isn't about getting rich quick, it's about building sustainable wealth over time. Now that you know the best investing tips for beginners, check out the suggested video for more wealth-building strategies. Watch it before it vanishes forever. Which of these tips resonated most? Comment below. I'd love to hear your thoughts. Don't forget to like, share, and subscribe for weekly tips to take your finances to the next level. Remember, your future wealthy self is counting on you. Go out there and start investing.